If you're 65 or over in the UK, what I'm about to tell you could protect your savings for the rest of your life. And almost nobody is explaining this properly. A brand new government rule is about to change how millions of people are allowed to save their money. But if you're a senior, there's a hidden exemption that could save you thousands of pounds and your financial freedom. Most people don't even know this exists yet. And if you miss this information, you could make the biggest financial mistake of your retirement. Stay with me till the end of this video, because this one decision could protect your money, your security, and your peace of mind for years to come. If you're over 60, retired, or planning for retirement, this channel is for you. This isn't entertainment content. This isn't noise. This is a protection channel. This is a financial safety channel. This is a channel for people who work their whole lives and deserve security, not confusion. I break down government rules, pension changes, HMRC updates, and retirement money news in simple language, without stress, without jargon, and without fear tactics. If this information matters to your life, your savings, and your future, then this channel is for you. Subscribe now so you don't miss future updates, because I will be uploading more videos on this exact topic, including new ISA rules, pension changes, inheritance tax updates, and senior financial protections. Hit subscribe, turn on notifications, and make this your trusted channel for retirement security, savings protection, and financial peace of mind. Because this channel isn't for everyone. It's for people who want clarity, safety, and control over their future. If you're 65 or over in the UK, what I'm about to tell you could protect your savings for the rest of your life, and almost nobody is explaining this properly. A brand new government rule is about to change how millions of people are allowed to save their money. But if you're a senior, there's a hidden exemption that could save you thousands of pounds and your financial freedom. Most people don't even know this exists yet. And if you miss this information, you could make the biggest financial mistake of your retirement. Stay with me till the end of this video, because this one decision could protect your money, your security, and your peace of mind for years to come. There's some really important news that's just come out from HMRC, and if you're age 65 or over, you're going to want to hear about this because it affects your financial future in a significant way. The government has recently confirmed that seniors age 65 and above will be exempt from a new rule that's going to change how younger people can save their money in the United Kingdom. This announcement has been making headlines, and many people are wondering what exactly this means for them. So let's break this down in a way that's easy to understand, without all the complicated financial jargon that usually makes these topics so confusing. So here's what's happening. The UK government under Chancellor Rachel Reeves announced in the autumn budget of 2025 that they're planning to make some significant changes to something called ISAs, which stands for Individual Savings Accounts. Now, if you're not familiar with ISAs, think of them as special savings accounts where you can put your money and not have to pay any tax on the interest or growth you earn. They're actually really popular in the UK because they offer this fantastic tax-free benefit, which means more money stays in your pocket instead of going to the tax authorities. Currently, every person in the UK can put up to £20,000 per year into these ISAs, and you can choose to split this money however you want between two main types of ISAs. There are cash ISAs, which are basically like regular savings accounts where your money sits safely and earns interest. And there are stocks and shares ISAs, where your money is invested in the stock market, which can potentially grow more, but also comes with more risk because the value can go up and down. Now here's where the big change comes in. Starting from April 2027, the government is planning to reduce how much of that £20,000 allowance people can put into cash ISAs. Under the new rules, people will only be able to put £12,000 into cash ISAs if they choose to. The remaining £8,000 of their annual ISA allowance will have to be put into stocks and shares ISAs if they want to use it. This is quite a significant change because it means people under 65 won't have the same flexibility they currently have to choose how they want to save their money. The government says the reason for this change is to encourage more people to invest in the UK stock market rather than just keeping their money in cash savings accounts. The idea is that if more people invest in stocks and shares, it will help boost investment in UK businesses and help the economy grow. But obviously not everyone is comfortable with the idea of having to put their money into investments that can lose value, especially if they need access to their cash for emergencies or other important expenses. But here's the crucial part that directly affects seniors, and this is the really good news for anyone aged 65 and over. The government has confirmed that if you're 65 or older, these new restrictions won't apply to you at all. That means if you're in this age group, you'll continue to have the full £20,000 annual ISA allowance, and you can put all of it into cash ISAs if that's what you prefer. You won't be forced to invest any of it in stocks and shares if you don't want to. This exemption was specifically designed to recognize that older people have different financial needs and priorities compared to younger savers. When you're in your retirement years or approaching retirement, you typically want your money to be safe and easily accessible. You might need to use your savings to cover living expenses, medical costs, home repairs, or to help family members. The last thing you want is to be forced to put your money into investments that could lose value right when you need to access it. HMRC officials have explained why they made this decision to exempt those over 65. Sarah McDonald, who is the Director of Individuals Policy at HMRC, spoke to members of Parliament about this at a Treasury Committee meeting, and she explained that the government was really mindful of the fact that people of pensionable age have different attitudes toward risk and reward when it comes to their money. Older people are generally more conscious about having liquid assets, which means having money that they can easily access when they need it, without having to sell investments that might have gone down in value. The government has data that shows people over 65 who have ISAs tend to hold more of their savings in cash ISAs rather than stocks and shares ISAs, which makes perfect sense when you think about it. When you're retired or getting close to retirement, you can't afford to take big risks with your money because you're not earning a regular salary anymore, and you need to make sure your savings will be there when you need them. The officials at HMRC were also asked whether they had taken legal advice about choosing 65 as the cutoff age for this exemption, especially since the official state pension age in the UK is actually 66, not 65. They confirmed that yes, they did take proper legal advice, and they're confident that their decision to use age 65 is legally sound and fair. The key factor was that the data clearly supports the argument that people in this age group need to maintain liquidity in their finances. It's worth noting that the state pension age itself is also changing over the next few years. Between 2026 and 2028, it's gradually increasing from 66 to 67, and under current legislation, it's set to go up to 68 between 2044 and 2046. But regardless of these changes to the state pension age, the exemption for the ISA rule changes will stay at 65. Now, some financial experts and people in the savings industry have raised concerns about these changes, even with the exemption for over 65s. They're worried that the government hasn't fully thought through all the potential consequences of this policy. Some industry figures who attended meetings with HMRC said it became very clear that these reforms were being made quite quickly without enough understanding of how regular investors actually behave with their money. They're concerned there could be unintended consequences that hurt savers rather than help them. For example, forcing younger people to put more money into stocks and shares might actually discourage them from saving at all if they're not comfortable with investment risk. There's also concern that the policy might be quite complicated to implement and could create confusion among savers about what they're allowed to do with their money. One industry representative said that rather than rushing to implement something that has fundamental flaws, the chancellor should go back and build a better evidence base for these reforms and make sure they're actually going to support retail investors in the long term. The government, for its part, has responded to these concerns by saying they're working closely with the financial industry and they'll publish clear guidance well before these changes come into effect in April 2027. They've acknowledged that they need to develop specific rules to prevent people from trying to get around the new lower cash ISA limit, and they're committed to making sure everything is properly explained so people understand what they need to do. But the key message for anyone age 65 and over is clear. You don't need to worry about these restrictions at all because you're completely exempt from them. It's also important to understand why this matters so much for older people specifically. When you're younger and working, you generally have time on your side when it comes to investing. If the stock market goes down, you can wait for it to recover because you might not need that money for many years. But when you're 65 or older, you might need to access your savings much sooner, perhaps even immediately in some cases. Imagine if you had to put £8,000 into stocks and shares ISA in April 2027, and then a few months later, you needed that money for an emergency like a major home repair or unexpected medical expenses. If the stock market had gone down during those few months, you'd have to sell your investments at a loss, which means you'd actually have less money available than what you originally put in. This is why having cash savings that don't go up and down in value is so important for older people. It provides security and peace of mind knowing that your money will be there in full when you need it. Another important aspect to consider is that many retirees and older savers have built up substantial cash reserves over their working lives, and they rely on these savings to supplement their pensions and provide for their daily living expenses. Forcing them to invest a portion of their annual ISA contributions in the stock market would fundamentally change their financial planning and could put their financial security at risk. The government recognized this reality, which is why they made the decision to exempt this age group. It's a recognition that retirement savings need to be treated differently from the savings of people who are still in their working years and building up their wealth for the future. It's also worth mentioning that this exemption fits into a broader pattern of how tax and savings rules often make special provisions for older people. For instance, once you reach state pension age, you stop paying national insurance contributions on any earnings you might have. There are also special considerations for pensioners when it comes to income tax, particularly for those whose only income is the state pension, as they often fall below the personal allowance threshold and don't have to pay income tax at all. These kinds of provisions recognize that older people have different financial circumstances and needs compared to those who are still in their working years. Looking at the bigger picture, these ISA changes are part of a series of reforms that are affecting pensions and retirement savings over the next few years. For example, there are changes coming to how unused pension funds are treated for inheritance tax purposes starting in April 2027. Currently, if you die with money still left in your pension pot, that money generally isn't included in your estate for inheritance tax calculations, which means your beneficiaries can inherit it more tax efficiently. But from April 2027, unused pension funds will be included in the value of your estate for inheritance tax purposes, which could significantly increase the tax bill for some families. This might change how people think about drawing down their pensions in retirement, because the old strategy of spending ISA money first and preserving pension funds for inheritance purposes might not make as much sense anymore. There's also an increase in the state pension age happening between 2026 and 2028, which will gradually raise the age from 66 to 67. This is being phased in month by month based on your date of birth, so it won't happen all at once. And then in April 2028, the normal minimum pension age, which is the earliest age you can access most private pension savings, is increasing from 55 to 57. All of these changes mean that retirement planning is becoming more complex, and it's more important than ever to understand what rules apply to you and how they might affect your financial plans. For seniors age 65 and over, the exemption from the new ISA cash limit restrictions is definitely good news. It means you maintain the flexibility and control over your savings that you've always had. You can continue to make decisions about how to allocate your £20,000 annual ISA allowance based on what makes sense for your personal circumstances, without being forced into investments that might not be right for you. Whether you want to keep all your ISA savings in cash for maximum security and accessibility, or whether you're comfortable putting some or all of it into stocks and shares, that choice remains entirely yours to make. If you're approaching 65, but haven't reached it yet, it's worth thinking ahead about how these rule changes might affect you once they come into force in April 2027. You might want to consider building up your cash ISA balances over the next couple of years while you still have the full £20,000 cash ISA allowance available to you. That way, you'll have a larger cash cushion built up by the time you turn 65. And once you reach that age, you'll be able to continue adding up to £20,000 per year to your cash ISAs if that's what you want to do, giving you complete freedom to manage your retirement savings in the way that best suits your needs and provides you with the security and peace of mind you deserve. The bottom line is this: if you're 65 or over, you can breathe a sigh of relief. The new ISA restrictions that are coming in April 2027 don't apply to you. You'll keep the same flexibility you've always had with your ISA savings, and you won't be forced to put any of your money into stock market investments if you'd rather keep it in cash. This exemption is a clear recognition by the government that older savers have different needs and priorities, and it ensures that you can continue to manage your hard-earned savings in a way that provides you with security, accessibility, and peace of mind during your retirement years. It's for people who want clarity, safety, and control over their future. If you're 65 or over in the UK, what I'm about to tell you could protect your savings for the rest of your life. And almost nobody is explaining this properly. A brand new government rule is about to change how millions of people are allowed to save their money. But if you're a senior, there's a hidden exemption that could save you thousands of pounds and your financial freedom. Most people don't even know this exists yet. And if you miss this information, you could make the biggest financial mistake of your retirement. Stay with me till the end of this video, because this one decision could protect your money, your security, and your peace of mind for years to come.